A lot has been going on around the globe, sending stocks down and then right back up. Right now it's a headline-driven market, so it's important for investors to understand that. Last Friday, Israel launched an attack on Iran focused on taking out their nuclear advancements. Iran followed up with a retaliation, launching more than 100 missiles of their own right back at Israel. This went back and forth for days until this past weekend when President Trump sent B-2 bombers escorted by Region fighter jets to drop bunker buster bombs on 3 main nuclear facilities in Iran. Here's a look at the clip from President Trump addressing the nation, claiming that this mission was a success.
A short time ago, the U.S. military carried out massive precision strikes on the 3 key nuclear facilities in the Iranian regime: Fordow, Natanz, and Esfahan. Everybody heard those names for years as they built this horribly destructive enterprise. Our objective was the destruction of Iran's nuclear enrichment capacity and a stop to the nuclear threat posed by the world's #1 state sponsor of terror. Tonight, I can report to the world that the strikes were a spectacular military success. Iran's key nuclear enrichment facilities have been completely and totally obliterated.
Obviously, no one wants to see war around the globe, but as of right now, it appears as if sides have agreed to a ceasefire, hopefully bringing an end to this short 2-week battle. So how did the markets react at the start of the week with the US bombing Iran over the weekend? Well, like we continue to see time and time again, this resilient market sold off a little bit, but then soared to new record highs. Not even a bombing could derail this market, but for investors, they looked at it as hopefully a quick end as markets dipped midway through the session before rebounding quite strong, and oil prices were sliding more than 7%. You know who didn't seem all that surprised by all of this and renewed his calls for higher highs heading into the second half was that of Tom Lee, who to his credit continues to be right more than he's wrong, something Cathie Wood could only dream of.
Joining us here at Post 9 is Tom Lee, Fundstrat Global Advisors, Head of Research, and Fundstrat Capital Chief Investment Officer, also a CNBC contributor. Tom, it's good to have you. Welcome. Talk about confounding expectations, wouldn't you say? What do you make of this morning's action?
Well, you know, in some ways it's not a surprise because, as you know, like Art Cashin had the adage, sell the buildup, buy the invasion. And I think today is an example of that markets were kind of already nervous and anxious, and we've already saw de-risking, and the VIX was already elevated. So I think in some ways this is probably pretty typical.
Does it change your call for the rest of the year at all? And you think it displaces any other priorities or has any effect on bill passage or how that might get constructed?
Yeah, in some ways it actually strengthens the case for stocks to do better into year-end, because at the start of this year we would have said U.S. bombing a nuclear facility is a black swan. Oil would be 120, stocks should be down 10%, and then we have the event and oil is not really surging and stocks are up. So I'd almost say that you've put another stress test into the market. We've seen it pass it, and I think it means stocks should do pretty well into year-end.
But I'm fully in agreement, because this is a stock market that continues to show strong resiliency. We've had tariffs thrown our way. We've had concerns over a slowing economy. We've had geopolitical concerns. Now we have Middle East tensions that are going on, and the stock market continues to tick higher and higher. Parts of me wants to be skeptic, and I think that's important for us as investors, is to be defensive in nature. However, we need to continue to invest and look for high-quality assets trading at great valuations. And in today's video, I'm going to give you a little peek into my portfolio. Not something I do here on YouTube all that much, but I'm going to show you the 3 stocks that I've recently added to my portfolio, bought more of into my portfolio. So make sure you stay tuned throughout the entirety so you don't miss one of these 3 stocks. And before we begin, show your appreciation for the content we put out here on YouTube by simply checking that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into the video, taking a look at 3 of my most recent stock additions to my portfolio, beginning with stock addition number 1, which is going to be ASML Holding, stock ticker ASML. And when it comes to this particular company, they operate out of the technology sector. We have all of these AI high-powered chips, and these manufacturing companies that are out there, they are all mostly built with ASML machinery. ASML is undoubtedly the leader in the space with a current market cap of $298 billion, but over the past 12 months, shares are down 22% and year-to-date up a little over 12%, outpacing that of the greater S&P 500. ASML is a brand new position to my portfolio. In fact, 2 of the 3 stocks that we're going to look at today are brand new positions to my portfolio. And as I mentioned a second ago, when it comes to ASML, they have the highest quality lithography machines that are out there. You have the likes of NVIDIA and AMD that design these chips. Then you have the likes of Taiwan Semi that manufacture the chips for a lot of these companies. And they're all built with ASML equipment. And capacity continues to be an issue. Just look at the new facilities Taiwan Semi is building here in the US. They are massive and they will need more equipment, more ASML equipment. So I added ASML as another way to play AI, a different angle. But I also did it because of the intriguing valuation. Let's take a look at a few valuation metrics utilizing my favorite research tool, which is called Fiscal AI. Such a powerful tool with everything you need as an investor. And looking here, we can see that over the past 5 years, ASML has an average price to earnings multiple of 34.5 times. Today, you can pick up shares for just 28.9 times. Earning growth over the next 3 years is going to average around 25%, giving the stock a PEG ratio of less than 1.2. But if you thought that was good, look at these. EV to EBITDA, one of my favorite metrics. Right now, ASML trades at just 22.9 times, well below the company's 5-year average of 33.4 times. Outside of the April lows, this is the lowest you've been able to buy this stock based on this metric since before the pandemic. You also get a little dividend with ASML, with a near 1% yield, but very strong dividend growth as they have a 5-year dividend growth rate above 20% and nearly a decade of consecutive dividend hikes. So ASML is going to be a play on continued growth with AI, a different angle to look and invest in AI, and the valuation is very intriguing. And now we're going to go to the second addition that I've made in my portfolio more recently, and that's with Alphabet, stock ticker GOOGL. And for those of you that are Edge Plus subscriber to my newsletter, The Stock Investor's Edge, you know that Alphabet is one of my top holdings. And if you're interested in seeing my entire portfolio, then make sure you subscribe today. Not only will you see trade alerts when I buy a position, but when I exit position. You'll get stock deep dives and our weekly Edge report. Check out the link down in the description below. But getting back to Alphabet, it is my single largest holding for an individual stock. The company currently has a market cap of $2 trillion, making it one of the largest stocks in the S&P 500 today. Over the past 12 months, shares are down 8% and year-to-date down 13%. I've talked a lot on this channel about my love for Alphabet, and a lot of it centers around how diversified the business is. Sure, they dominate search with both Google Search and YouTube, but they're also a major cloud provider. They have subscriptions, they have AI, they have driverless technology with Waymo, which happens to be a leader, and oh yeah, they're also building their own custom chips. But one of the biggest growth drivers for the company is just how dominant YouTube really is. Look at this Nielsen data from February of 25 showing YouTube dominate all the major media companies such as Disney, Fox, and Netflix from a viewership perspective. YouTube is even growing their sports presence. You get all of this, plus a great leadership team, a sound balance sheet, and growth moving forward. This is a company that's trading at a fantastic price. One that I don't think will be this low for that much longer. Even though it was my largest position in my portfolio, I still couldn't pass up this valuation. So let's jump back to the fiscal.ai dashboard and take a look at some fundamentals. I obviously want to see companies grow their revenues, but more importantly, I want to see companies grow their margins. And Alphabet is doing just that. Record revenues on record margins. Looking here now at valuation, we can see that over the past 5 years, Alphabet has a PE of 23.5 times on average. Today, you can pick up shares for less than 18 times, which is just comical. From an EV to EBITDA perspective, right now shares trade at just 14.3 times, one of the lowest in the company's history and well below their 5-year average of 17.6 times. So with Alphabet, you get a diversified company, a dominant advertising company, an AI play, all trading at a fantastic valuation. This was probably the easiest buy for me. And that's going to bring us to stock addition number 3, which is going to be Salesforce, stock ticker CRM. This is the most recent addition to my portfolio and a brand new position at that. This is a company that's been on my watch list for some time now. And because it was new, I wanted to make sure that I dotted every I and crossed every T here. Looking at the fundamentals, looking at the balance sheet, the margins, and the growth ahead. And it checked off a lot of those boxes, which is why we entered a new position with Salesforce. The company currently has a market cap of $249 billion. Over the past 12 months, shares are up 10%, but year to date, shares are down over 20%. And a lot of those selling pressures this year centered around the company's Q1 earnings report. Sure, growth has been slowing, a valid concern. But more important to me, again, just like I talked about with Alphabet, is how efficient a business is coming. As growth comes down, is the company finding ways to be more efficient? The answer for Alphabet and Salesforce is yes. And when we talk about AI, Salesforce is yet another AI play. I believe that it's in phases when it comes to AI. Building out the infrastructure is the early phase. That's where we're at right now. But moving into the next phase is where software comes into play. And with Agentforce, Salesforce is sitting in a prime spot. Jumping back to the fiscal.ai dashboard, let's take a look at valuation, where looking here, we could see that Salesforce shares are trading near decade lows in terms of PE ratio, with just a 22.6 forward PE, well below their 5-year average of 36.3. From a price to free cash flow position, shares trade below 20 times, again, well below their 5-year average of 32 times. And from an EV to EBITDA perspective, right now, CRM shares trade at just 22 times, one of the lowest in the company's history and well below their 5-year average of 39.5 times. So again, with Salesforce, it's another angle, another way to play AI from a software perspective. And they happen to be trading at a fantastic valuation. So there we just looked at 3 stocks, 3 new additions to my portfolio. And again, if you want to see my entire portfolio, what I've been buying and some of the recent sales that I've had, then become an Edge Plus subscriber. Again, you can see that link down in the description below. Down in the comments though, let me know which of these 3 stocks would you also be buying at current levels if you only had to choose one. Would love to read those down in the comment section. If you haven't done so, show your appreciation for these videos by simply clicking that like button down below. Subscribe to the channel. We'll see you in the next one. Take care.